So let's dive right into a really fascinating question, one that is literally reshaping the entire global financial landscape. When a bank funds a factory, whose pollution is it? Now, for a long time, the answer was treated as solely belonging to the factory. It was their problem. But today, well, the world of finance is undergoing a massive paradigm shift, and that responsibility is moving straight upstream.
Welcome to this explainer. Today, we're basically going to put on our carbon detective hats and unpack the incredibly strict new climate reporting rules for commercial banks. We're going to see exactly how these massive financial institutions are now being forced to open up their books and reveal the true environmental impact of every single dollar they lend out. We've got a pretty clear roadmap for our investigation today. We'll start with the new banking standard, explore ESG and credit analysis, look at tracking financed emissions, define the specific scopes of those emissions, and finally dive into how banks must reveal their gross exposure. Part 1. The new banking standard, which is essentially the rulebook for climate transparency. The ultimate guide for what banks actually have to disclose now is the SASB Sustainability Accounting Standard for commercial banks, specifically version 2025-12. This framework is now under the stewardship of the ISSB, that's the International Sustainability Standards Board, and it acts as the definitive roadmap for the industry. Because the ISSB has amended these standards to align with rigorous global climate-related disclosures, it's become an incredibly powerful tool for true accountability. And this perfectly illustrates the core problem we're dealing with. Historically, a bank's indirect emissions were a total black box. They were completely hidden from the public and from investors. Because there wasn't any standardized reporting, banks just weren't held liable for what their clients did. But starting with reporting periods in 2027, they have to step out of the shadows, they're forced to pull back the curtain and show us the actual climate impact of the money they lend out. They simply can't pretend anymore that providing capital has no connection to the real-world consequences of how that capital is used.
Moving on to Section 2, ESG and Credit Analysis and a Banker's Totally New Mindset.
It used to just be about looking at traditional financial balance sheets, right? Not anymore. Loan officers now have to qualitatively explain how environmental, social, and governance, or ESG factors, are actually incorporated into their daily credit analysis. They literally have to assess how a new carbon tax or new fuel efficiency regulations might interact with central bank policy and big geopolitical risks. They have to look at microeconomic trends too, like what if consumer demand suddenly shifts away from a highly polluting product? Ultimately, they have to explain how these specific ESG risks directly alter a borrower's overall creditworthiness. It even influences the maturity or tenor of a loan, meaning exactly how long the borrower has to pay it back. For instance, if a strict new carbon tax is going to absolutely crush a borrower's future profitability, a bank might shorten that loan's tenor to protect themselves. That completely changes their calculation of expected losses and the true value of the posted collateral.
And to prove they aren't just greenwashing, banks have to show their work. The standard demands they detail the exact steps of their implementation. A vague PR statement just won't cut it. They have to specifically outline who is responsible for the day-to-day ESG research, what roles those employees play, and what formal oversight bodies exist to hold the institution accountable. They even need to spell out the specific criteria they use to judge the quality of their ESG integration when they're assessing borrowers under these brand new risk models.
Which brings us to Section 3, Tracking Financed Emissions, otherwise known as the hard data.
This is where all that qualitative talk gives way to unavoidable, rigid math. Specifically, under Code FNCB 410B, the standard requires the disclosure of absolute gross financed emissions, measured in metric tons of CO2 equivalent.
Basically, a bank is now mathematically accountable for the carbon trail of the businesses it chooses to finance. By tracking these financed emissions, a commercial bank is essentially measuring its exposure to massive technological changes, shifting supply and demand, and sweeping policy shifts. If a bank has highly concentrated lending in carbon-heavy industries, this metric will light that up for all stakeholders to see, highlighting their immense credit risk, market risk, and reputational risk.
Let's look at Section 4, defining Scopes 1, 2, and 3, and tracing that carbon trail.
The standard demands that a bank's absolute gross financed emissions be strictly disaggregated. They can't just throw out one big number. First, they have to report Scope 1 and 2 emissions. That accounts for the direct emissions from a finance company's own sources, like the exhaust coming out of their delivery trucks, plus the indirect emissions from the electricity they buy to run their operations. But the real game changer here is Scope 3. Scope 3 covers all the other indirect emissions occurring up and down that finance company's entire value chain. It leaves absolutely no stone unturned. And as you might guess, Scope 3 is notoriously difficult to track because it requires gathering precise data from third-party suppliers and end consumers who probably aren't routinely tracking their own footprints.
Now, this level of strict disaggregation is absolutely crucial. Why? Because it stops banks from obscuring massive value chain polluters behind otherwise clean direct operations. Think about an oil company. The actual burning of that oil by everyday consumers is a massive Scope 3 emission, and it must be calculated and reported by the bank funding them. By preventing financial institutions from just lumping all these numbers together, the standard forces a level of clarity that reveals the true, unvarnished depth of the bank's climate risk.
Finally, we reach Section 5, revealing gross exposure, or finding out exactly where the money flows.
So banks can no longer just generalize their portfolios. They are explicitly required to disclose their gross exposure for each individual industry, and then they have to strictly divide that down even further by asset class, like separating corporate loans from commercial real estate. All of this has to be expressed in the normal currency of their financial statements. On top of that, they must completely explain their math. They have to describe the methodology they use to calculate these financed emissions, including the exact method of allocation they use to attribute their specific share of emissions relative to the size of their exposure. They have to show the whole shebang.
And what is the ultimate target for all of this? 100%. The overarching goal of the standard is to have 100% of a bank's gross exposure included in this financed emissions calculation. Now, the standard acknowledges that this is really difficult, so it's built with a catch. If a bank's calculation covers less than 100% of their gross exposure, they are legally required to disclose the exact percentage they did cover. And they must publicly justify and explain any exclusions, including exactly what types of assets they decided to leave out.
We've seen just how comprehensive these new SASB and IFRS standards really are, right? From integrating ESG factors into daily credit analysis to strictly disaggregating Scopes 1, 2, and 3 emissions. As we wrap up this explainer, I want to leave you with this final, provocative thought. When the carbon trail of every single dollar is finally illuminated for the entire world to see, and banks can no longer hide their gross exposure, how will that unprecedented transparency fundamentally rewire the future of global finance? It's a huge question. Thanks so much for joining me, and keep questioning where the money goes.